Great. So again, formally, welcome to coming to this meetup group on the topic of opportunity zones. My name is Karl Dakin. I have a consulting firm called Dakin Capital LLC, where I work with businesses and individuals, social enterprises, and now some charities at the current time, helping them design, stage, and implement capital campaigns. And I learned of opportunity zones in March of last year and thought that it might be the game changer, the tipping point for a lot of projects, and started to learn more. And because of the way the thing's designed, I actually do think that this source of capital is giving everybody a lot more options. It's not going to work for everybody. But it is going to be helpful to a large enough group of projects. I think it's going to have a significant impact on specific projects and collectively across the United States. Tonight we're going to be talking about innovation hubs. It's a concept that I'm advancing in the context of community development. It has some ancestry in the form of incubators and accelerators and co-working spaces and so forth. That we'll be drawing upon, and also some of the more advanced thinking in terms of innovation districts. But what it has the opportunity to do is act as its own economic catalyst side by side with other types of projects in a community. And I think that a lot of communities may want to think about embedding this into their master plan for the community. And then to my left, I have Julio Zimbron, who has a parcel of property in Fort Collins, Colorado. It's a developed commercial property of 2.3 acres, and he posed the question to me because he's in an opportunity zone. How could opportunity zone investment help him enhance the property, increase revenue, improve some aspect of this particular property ownership? And so we're going to talk about some of the different options that he has as we go through tonight's program. Many of these issues, questions, will be things that might be common to any commercial property that's already developed or partially developed. And so, but feel free if you have a question that seems like it might be off the mark or something. Don't worry about that. Go ahead and ask the question, because our primary purpose here is to help answer your questions as best we can on opportunity zones, and to continue to build the knowledge on opportunity zones so that people who are thinking about it or just learning about it can get up to speed, can get comfortable with the concept and determine if this is something they should do, and possibly even inspire them to take on something that previously they had tried and didn't work, or they thought maybe it wasn't a good fit. So with that, we will get started here. An opportunity zone is essentially a tax incentive, and there are three primary incentives that come from opportunity zones. If you have any asset that you sell at a profit and it qualifies as either a short-term or long-term capital gain from a tax standpoint in the United States, you have an option to take that money, invest it into a new entity, which would be an opportunity zone fund, and in turn that opportunity zone fund will invest into a business or a property that is within an opportunity zone area. And if this occurs within the time frames that are laid out, then you can defer paying taxes on the gain that you have. So as an example, if in 2018 you made $1,000 in capital gains from selling a stock or a piece of property, you would, right now, unless things change, you'd be paying taxes on that at your capital gains rate on April 15th. But if you took that same money and rolled it over into an investment that qualifies within a fund, then you have the ability to defer the taxes that you have to pay until you come out of that investment, or the later date of 2026. So any kind of rollover is ultimately going to be taxed on 2026. But if you come out of the investment earlier, then that will trigger the payment of the capital gains tax. If you make the second benefit is that if you leave this money in for a long period of time, 5 years, then 10% of capital gains tax that you would otherwise owe today is waived. So you're now only going to pay 90% of the capital gains tax that you otherwise would have paid. If you leave it in another 2 years, then you get another 5% knocked off of that, which means that you're now only going to pay 85% of the capital gains tax that you otherwise would have paid. And that's your second benefit. So you get a discount of taxes that otherwise would have been owed by putting money into one of these funds correctly for a long enough period of time. The big winner, the big benefit of Opportunity Zone funding is the third benefit. And if you put money into an Opportunity Zone fund and you leave it for 10 years and that investment goes up in value, then that gain in value, that appreciation, that when it's realized is 100% tax-free. So they've done some comparisons of what this would mean if you were buying stocks and you instead invest in an Opportunity Zone. They talk about a 3.5% greater net to the bottom line because you're not paying taxes on that gain somewhere down the road if you're just investing in an average stock index. But if you put it into real estate, they're estimating that you're probably getting a 5 to 6% increase in net take-home money because you don't have to pay taxes at the end of 10 years. But if you're investing into something that has hockey stick potential, it's a big gainer type of thing, which could involve certain types of real estate, certain types of technology. All of that gain could be a massive take-home without tax liability. And so right now, everybody who is a wealth manager, anybody who's having capital gains is looking at this from both a strategic and monetary standpoint, trying to figure out, is this something they should do? And everybody's trying to learn about this as quickly as possible. The law was passed in December of 2017. The first proposed rules were published in October. The rules are not final. More rules are coming, so this is not a well-defined area yet, even though the whole statute is available and working right now. So we're going to see more refinement. We're going to see more questions answered. We're going to get better understanding of this. And as that happens, we expect people to push the envelope more and more to figure out how far they can make an investment and still make a return out of it.
Hey, Carl.
Yes?
If we were to invest tomorrow, how far behind the curve are we on this? I mean, how new is this, and how much have people started investing already in this type of fund?
So the question that's been asked is, if we were to invest today, where would we stand in the spectrum of, are we at the front of the line or the back of the line or somewhere in between? To my knowledge, only a handful of investments were made in 2018, partly because they couldn't get the money together, or the funding was in the wrong structure, or they are concerned that they were too close to the December 31st deadline when the money has to be deployed up to 90% of the fund. So right now it looks like everybody's scrambling, coming together. This thing is going from interesting to highly popular in a hurry, but it's still difficult to identify funds and projects that are ready for funding and match those up. So I would say that if you invested today, you're still at the front of the line, and you're still pioneer, and there's still potential for high risk at this point in time as a consequence. So on this map that I have up here, this shows the opportunity zones for the state of Colorado. There are 126 areas. Some of them are very, very small, not visible unless you blow this map up. But at the bottom of the page, this is the link to the Colorado Office of Economic Development and International Trade, where this map is available in an interactive format. So about 5 times a day now, I'm popping this up, trying to determine if somebody's in an opportunity zone or not, for purposes of deciding whether this is something that somebody should look at with greater detail.
So sorry, Carl.
Yep.
Are there entire counties that are opportunity zones?
There are, yes. So Julio's question is, are there entire counties? And the answer is yes. So Crowley County, and I think 3 or 4 other counties, the entire counties included. And there are also entire counties that are not. So I was talking with a person from Sedgwick County, which includes Julesburg, this afternoon, and they basically were not included. What the selection process was that you had so many census tracts based upon economic income, and each state was allowed to select a percentage of all those tracts. And some states just kind of wishy-washy picked different things without any real rationale. Colorado did an excellent job in the 3 months they had to look at existing zones such as enterprise zones and other places. They looked at the potential of the property to be developed, and their goal was to go from good to great and not go from bad to maybe poor. So some were left out. But again, the way the rules work, 90% of the money has to be allocated within a zone, but a fund has the ability to take 10% of that money and put it outside of a zone. So as I was talking with the person this afternoon, if they got 9 other projects of a similar nature in a coalition that are within opportunity zones, then the fund would have the option of funding them outside the opportunity zone and still making this work. Now, as the money trickles down, if the money's put in from the fund to a business, okay, the business is required to put 70% of their tangible assets, real estate and so forth, spend that within the zone. So technically, if the fund puts in 90% and then into a business, the business does 70%, only 63% of the total money in the zone is being allocated there. And then the business itself, in terms of operations, as opposed to purchasing hard assets or property, only has to spend the majority of that on its operations. So if it's a service business, for example, where they're not buying a lot of hard assets, they only have to spend half of that money within the zone and do business within the zone. And at this point, it gets very fuzzy, very vague, and it'll be very difficult. We've seen similar types of guidelines in the crowdfunding statutes and other statutes where you have to have all the money raised in the state, but you have to spend 80% within the state. And the definition of spend within the state's never been well defined nor very strongly enforced. And by and large, if you're headquartered in a zone and you're employing people in a zone, you probably will do fine as far as meeting and conforming to the rules. But if you're going to be conservative in the design of your fund and your business, you'll want to do some analysis on that, particularly on those businesses where you might get a drift, where you might start in the zone but suddenly find a bunch of business outside the zone, and it looks like you're diluting your impact. It's not clear at this time if you start a business in a zone and take it outside of a zone, whether or not that's going to blow up the investment. It could very well do so. I would assume for the moment that if you move the business outside the zone in your 10-year time period, you're going to lose your qualification. So what we're seeing then is these tax incentives are making everything more attractive to the people. And somebody asked me at the deal-making conference, he says, well, so what really is the difference? And so I use this metaphor is if you go to the amusement park and you're not tall enough, you can't get on the ride. And what we've seen is a lot of projects that are good projects but low ROI but maybe higher risk. And this is true for actually the vast majority of all small businesses fall in this category. They're not strong enough, not attractive enough to be visible to classical sources of capital. So what the Opportunity Zone is doing is it's giving them kind of a 6-inch platform to make them get to the point where they're now visible and now qualify for whatever criteria have been set up by the different investors. If you're doing it strictly in ROI, then this is giving you that slight elevation. You're now more visible because if they said, well, I need a 6% return and this thing only pays 5%, well, with the Opportunity Zone incentives, you may get to 6, 6.5, and now this is something that will meet the criteria. What we're finding in the communities, though, is that they're not looking just at the ROI. they're also looking at non-monetary incentives or benefits to the community. So business may not be making that much money in the community, but it's hiring 5 people at prime jobs above the average income for that community, and that's a big deal. So you may see mixing and matching monies where the community will come in with willing to take a lower ROI or disproportionate amount for the same amount of money invested in a project. And the Oz money may come in as a pure ROI with a higher ROI, and the combination together will get the job done. So we may see some matching type of grants and other things taking place that otherwise wouldn't get us where we want to go. So at this point, I'm seeing what I call innovation taking place. We've had some wonderful conversations about, yeah, we know this is the way you used to finance a deal, but if we do it differently, if we do a rev share, if we do some kind of municipal bond district or something that maybe it could have been done in the past, but somebody didn't want to test the waters, that for whatever reason, Opportunity Zones is acting as an inspiration to go, let's try this differently. So we're seeing some things in equity share on housing that would allow people to build wealth in a house where they wouldn't otherwise. We're talking about some people and doing long-term career track skills training where the employee is paying a percentage of their wage into a pool in exchange for ongoing education, and some very interesting things. And I think that with innovation and some of these new financing models, which also are showing up in the energy area in particular, we're going to be able to expand the impact of Opportunity Zones beyond what would be otherwise. So this Opportunity Zone Meetup has 3 primary goals. The first one is to share information, and so tonight's program is intended to make you more aware of this, introduce you to other resources, other contacts, other people, help you guys network, particularly those who are working on projects so you can share information. We're going to do a lot of case studies. We're going to try to push the envelope. We want to be out at the tip of the spear, saying here's a live project that's in motion, and as a project comes to completion, our goal is to package these up, put it into a mini do-it-yourself kit that communities can download and use as a starting point. And then we're going to come across issues. Some of the questions you ask, despite having been to so many conferences and webinars so far, still are the first time I've heard the question, and so we'd like to get those answered and see if there's something. If we can't answer it tonight, we're developing a list of people who are also out at the leading edge of this topic, and we'll be able to bounce those questions out to them and see if we can get an answer back. If it's done quickly, it'll show up in the guide that is given out with the program. If not, it'll go to the discussion page on the Meetup site. So a lot of you may not be aware, but every time there's a great article or a video or anything we're doing, we're posted in the discussion page where you can find it and download it, and building that as an ongoing resource site. For tonight's program, you will get a guidebook. You'll get a link to a guidebook. You'll get a box.com link that will have a digital program like this in it. This is a deeper narrative with more information. Some of it will be repetitive from session to session because we're just trying to, again, lay the groundwork, and then we're going to keep adding to this so that there'll be more resources at the back, and over time this will become bigger, thicker, which is why printing it is becoming problematic. So the next 24 hours you'll get a copy of the slide deck and a copy of the guide, and then approximately a week to 10 days later we'll have the video done for tonight and we'll post it up. And we're still working on the goal of making this a live broadcast so that we can reach out. And in case any of you didn't see the announcement this morning, we crossed our 100-member mark this morning. So really happy with that and the size of this group, because we've got people all across the state, and we'll also have a few people outside the state who are following this work. So now this will take us into tonight's program. It's a case study. It's an innovation hub, and we're going to be talking about this property. This is the point, I guess, a backdrop for this is if you see a project and from a community standpoint and you're saying, where are we at? everybody that I'm talking to says, well, we're just trying to get to a level of financial or economic equality with the more affluent communities that are out there. And I'm kind of leaning back on them and telling them that this is your moment to take this money and get ahead. Start thinking long term, start thinking about what you need to put in place to keep this community growing over the next 10, 20 years. What can you do to create an economic platform or bring a new business and spin it up so that you're ahead of the game and not behind the game coming out of this funding. So I think that at a community level where they're talking about bringing these communities together and doing multiple projects, and right now we're seeing about 10 common issues coming up. We have jobs, housing, we have infrastructure, education. Typically we may be seeing a single industry in a community and other things of that nature. Add innovation to the list or add it to each project in the list for the community. Thinking about what you can do new or differently, something that isn't the status quo, not implementing again the very systems that put the community into a distressed economic condition. So what can you do that would be different? So one of the things that we're going to be looking at tonight is whether or not we can create a culture of innovation as part of this. There's a great article that came out a couple years ago now from the Brookings Institute on innovation districts. There was at least a summer of articles and so forth. This is one of the best ones that's out there. And they're basically pointing out that innovation occurs when you have certain key components in a community in close proximity that are not silos staring at each other across the street, but have some kind of programs or interconnection that's taking place. And in some areas in Boston, they had an old wharf area where they redeveloped it, but they did it in a forward-thinking manner. And regardless of scale, this is something, again, that would be looking at. So even if you're doing something as simple as a four-part multifamily real estate unit, give some thought to what you could do to make that more valuable to the tenants. That's either going to help them keep their job or get a better job or have a better quality of life, because it will impact value over time, and it may make it more saleable, allow you to have a better price point on it. And the fix and flips that we're looking at doing, we're talking about the fact we're probably going to put solar on every roof. We're going to look at maybe replacing some of the internal systems, and these houses will have a much greater, longer lifespan as a consequence, and a much higher, better quality of life within the four walls as a result of that. So this is a link to the Brookings Institute paper. It's still available online, and it puts out a number of these concepts about what you might look for in an innovation district. So that brings us to Julio and his piece of property. The formal address is 200 Airfield Park. The reason why it's called Airfield is it's next to the old airport up in Fort Collins that closed in 2006. And so the question we're looking at for Julio is, what can he do with this property using opportunity zone investment that will then either match up with a community goal or some other person's goal, so that one, it attracts the money in, and it may give you a much, much stronger property in terms of revenue and other things. So the general description is it's a 2.3 acre parcel. It's just a short distance away from I-25 and actually a longer distance away. I guess it's about the same distance from Old Town in Fort Collins. And there are 4 primary buildings and altogether. So you want to tell us a little bit more about the property and how you got into this and what you're thinking?
Okay, so I am a small business owner, and about a year and a half ago I wasn't sure that I would have a space because I am on a short-term lease at one of the business incubators in Fort Collins. This particular one is within CSU. So I started looking around, and then I found this property, and And it was bigger than what I was thinking or needing, but I was happy that I could qualify to purchase it. So if you can you go back one slide so I can tell you a little more about it. There is 5. Is there a pointer? Do you have a pointer, Carl?
There may be. Let's see.
Or I can.
You ask me all these hard questions.
I can stand and perhaps it's actually 5 buildings. So right here, this is an original farmhouse. It's on the edge of a little creek. All of this is flood zone. So from the 2.3 acres, only a small portion of that is usable. So that's the original building, very small, about 600 square feet. And then there's these add-on buildings. So 1, 2, 3, 4, plus the original house. And all in all, it's about 16,000 square feet. And they're all different qualities and vintages. The picture that you had, Carl, does this work?
Yeah, and go left then. Yeah, here we go. Okay. 1
I
second.
didn't do anything other
No,
than...
no. There we go.
Okay, there it is. Thank you. So those particular pictures are probably for the I call that the shed. It's clearly a shed that was put together for a farm, and it's about 4,000 square feet. But that can tell you that it needs a fair amount of work. So I purchased this last May, and I was trying to work out deals with some of the tenants, and some of them work out, some of them didn't. But right now I'm trying to look at cash flow and trying to have the mortgage paid, and it's getting there. It still is going to take some additional investment, but I am pretty excited about this property. It's in Fort Collins. I know how familiar you are with the situation of real estate in Fort Collins. This is within the county. It's not, but it's surrounded by the city. So looks like it's going to be annexed pretty soon, and the city master plan indicates that there's no more commercial or industrial property. So with the area continuing to grow, the demand for this type of property is going to increase, and the supply is fixed. So that's good news for an owner like myself. One other thought is that, there's a number of innovation hubs in Fort Collins. There's the Inosphere. There's also the RIC where I am at. This is part of CSU. It's called the Research and Innovation Center. And there's also a number of shared spaces. So one of the ideas that I have is probably turn this into shared space and taking advantage of really the development of Fort Collins as a bit of an innovation hub. Recently there was a report that Boulder, Denver, and Fort Collins were among some of the top cities in the U.S. for innovation. So,
yeah, so with that starting point, I then went out and looked at some other projects that are being discussed across Colorado that might be called an innovation hub or a co-working space or co-manufacturing or co-something, laboratory space. And I have worked with incubators and accelerators throughout my career and familiar with the Inosphere. Mike Freeman's the leading incubator in the state of Colorado. They now have branches, I believe, in 5 different cities, including here in Denver. And their focus is primarily on fast-growing, big-growing businesses. So they are aligned very well with the angel capital community, and they've actually started a new international fund, and they're doing a bunch of great and interesting things. So it's still growing and still trying to fill, in my mind, a big gap that exists in our community. We've got other incubators and accelerators out there that are nonprofit economic development, but they may lack a focus. They may be a general purpose, generic thing. And then we have more and more co-working spaces every day. It seems I can't turn a corner without finding a new co-working space out there. And so you're going to see differences, though, in value and in markets and in tenants who would fill those, which we're going to talk about here a little bit, because they may want to increase the cost substantially in order to meet the needs of the tenants. They also may grossly limit who can be a tenant or want to be a tenant in that building. So there's going to be some trade-offs and some discussions along that line. This property is clearly in the Opportunity Zone on the northeast part of Fort Collins. It's not at the edge, so we didn't have to worry about that. And it's just a little bit to the north and west of there is the Sugar Beet District project, which was the subject of our first meetup back in October, November. And that project is continuing to move forward and about to get some traction. And this is by far a much smaller project, and as I said, more typical of small commercial projects that all of you may see somewhere. I came up with a number of different models that are different levels of complexity and cost and so forth that might be appropriate for this particular property. The first one, I called it a co-working space. One of the buildings is about 4,000 square feet of what looks like, I would say, just an open warehouse. And one of the problems we've seen come up with opportunity zones is there's businesses out there who would probably be a good match, but they're not in an opportunity zone today. And so they may want to relocate in order to make themselves eligible for the funds. So I use the picture of the mailboxes here because this would give them an address inside the opportunity zone. Also, we're seeing a lot of service businesses today that don't have property, don't have tangible assets, no significant equipment, and they need a home base. And as long as they're performing 50% or more of their work within the opportunity zone, then they could simply buy a mailbox and meet the requirement from there. There isn't a greater requirement of anything other than being headquartered. You don't even have to be headquartered. You just have to have 50% of your work within the zone. But they're looking for jobs, and so this would be one thing to do. Now, obviously, you can throw in desks and chairs and IT and Wi-Fi and make this into a regular style co-working space. And then that would be a very simple thing to do, would be a very minus cost and might not even justify a third-party investor getting involved.
So for this model, Karl, if somebody sets up a startup company, does the funding capital need to come from capital gains or just being located in an opportunity zone brings advantages?
Well, by being in the opportunity zone, then they qualify for opportunity zone investment from an opportunity zone fund. Mm-hmm. If we go back here and say you're about 20 blocks north of where you're at right now, you'd be outside of an opportunity zone fund. Mm-hmm. Same business, just in a different geographic location. And from a funding standpoint, you're saying, well, if I want to raise money today, I'm actually competing against every business within an opportunity zone fund. I'd be better off to move my headquarters, particularly if it's not a big deal, to use a co-working space rather than working out of my house or my garage or something of that nature.
And a business that wouldn't need that large funding needs probably wouldn't be able to draw any advantage of being located in an opportunity zone. Let's say a freelancer.
Yeah, if you're a freelancer and you need $25,000, $50,000, it would be hard to justify going through all this. You still might have to create your own opportunity zone fund because you might not meet the criteria of one of these larger funds, and just that time and paperwork might be too much. So at this level where we're talking about a very minimalistic thing, this may not be big enough to justify funding. If we move to the second one, where we make this a co-laboratory or co-manufacturing space, generally what you're seeing in these is you're starting to become themed to an industry, even a sub-segment or sub-sub-segment of an industry, and you're going to start putting in specialized equipment. So you might put in a CNC machine, you might be putting in spectrometer, chromatography for the hemp industry, something to assist in extraction of THC to make a THC-free hemp. And all these pieces of equipment start costing money, and it can mount up very quickly to a sizable enough investment to justify considering going out and putting together a fund and having people come in and put money into this project. And by putting this equipment in there, you're going to become attractive to those tenants who can't afford to buy this on their own and are willing to share this equipment or laboratory space. One of the things you may do to the building is you might take a wall, put in a series of ventilation hoods that would have the necessary scrubbers to meet the clean air requirements, and people could run experiments or come in and do different things. So there's a whole variety of potential here. This is still a relatively small dollar investment, but you might be looking here at between $50,000 and $1 million of specialized equipment that would make this highly desirable for people who can't afford that by themselves. The third level would be to pop in a new building. As Julio said, the long building in the picture is kind of an old shed, and it's at the end of days, it's a nice way of putting it. You could still do certain kind of businesses in there, but you've got a very limited range because of the capability of the building. So if you scrape that and put in a building with some height in it, and I don't know what the height requirements are there now that the airport's closed. Do you know what the zoning might be on that?
I don't know. I understand very well the zoning, but for example, less than half a mile away, there's 3 or 4 story housing buildings. There's also the new Woodward Governor's campus, and it seems to have tall buildings, but I don't exactly know what the limit is. My guess is at least three.
Yeah, I would suspect that when these buildings were built, the airport was working at that time, so they basically may have had a 2-story limit on them as a result. But now that the airport's closed, there may be an open-ended ability to put 3, 4, 5 stories up, which allows you to get a more intensive use of your space. And obviously, if you put in a new building, then you can design that building to fit for, again, a certain type of tenancy or a higher grade of tenant or something that might not fit in any of the existing buildings. And as a new building, then you also have the ability to finance that in different ways, and we'll talk about that a little bit more in a moment. The fourth thing would be to add housing to the property. You've got that small little house, the original farmhouse that was there, and the creek actually has a lot of trees along it. It might be interesting to see if you could put 4 8 units of housing there so that the people who are working at one of these buildings can walk basically across the parking lot. And you also are getting a different type of building with a different revenue stream that could be running independently of your office building or space. And every community I've talked to, housing is a problem. Some of them, again, are taking a very old school approach, which is throw up more stuff. Some are doing a lot of the affordable housing, but the new market tax credits are limited, so they're still behind the curve on filling that housing gap. And it doesn't matter whether it's a small rural community or an urban area, everyone's talking about housing. So if you could even pop up 8 units in there somewhere, that may make this all more attractive for a variety of reasons. The fifth one is to go virtual, that is to go beyond the physical, go beyond what's there. So if you have an office with not an office, but a workspace with equipment in it, you might become part of a CSU program or a high school program. You might help the community by putting in a makerspace type of program and start doing things that extend beyond this, so this building is more like a hub, true hub, where its reach and impact goes beyond the physical limits of the property. So you might have what you call partial tenants who come in 1/2 day a week and use part of the facility. They're not on site, but they've got a need for the same equipment, but they don't need it intensively. So you're looking now at trying to be something broader. You're also looking at integrating partnerships within the community and other things that give more value to this and make it kind of a destination point for some of these programs. The last one is infrastructure. This may not specifically apply to your situation, but in a rural community, if I were looking at a commercial development, I would also start looking at the infrastructure of that community, wastewater, power and also Wi-Fi access. So you might want to put up a WiMAX tower and create another business or sub-business. If you had enough space, you could put up your own solar panels and create your own private power company to support all the businesses that are on your site, or if it's large enough, it might even reach beyond your property to the adjoining properties within an industrial district. You might want to look at getting off the grid or getting out of the wastewater system. There's a variety of things there that are becoming possible as new technologies come on board. And again, in a rural community, what we're finding is that the communities have a system that's 30, 40, 50 years old. It may have been grandfathered in and is no longer technically meeting health requirements, but it's allowed to move forward because the cost of replacement is, they just can't do it. We've talked to a few communities about creating public-private partnerships where we would take over the water purification. We would change out, particularly the open-air evaporative sewage systems with a recycling system to create byproducts out of the waste and recapture the water. And almost everywhere could use a power grid of some kind, whether it's a small solar field or it's doing something of that nature, but adding power to this component could make a difference. On 2.3 acres, I'm not up to speed to give you a hard guess on whether or not that's large enough. But it's also, you know, you've got, I'm not sure what they're doing with their airstrip over there a block or so away. There might be some interest in converting that into a solar field of some kind or some other type of activity.
That's privately owned. It's a very large piece of land.
Yeah, so this is where you start talking to your neighbors and you start, you know, sharing ideas of what you can do as a group as opposed to doing it on your own. So this are the 6 kind of models that occurred to me in looking at this property. Some of them I think are very fitting for what you're doing without necessarily over-engineering or putting too much weird, expensive equipment in there that wouldn't have a big draw. But it might work to your advantage. You don't know. You might say, well, if I put in this piece of equipment, I only need 4 tenants to make my pay my bills correctly, where the other one's more generic, you've got more competition. So then we looked at investor candidates. One of the ways to raise money for this would be to do an Opportunity Zone Fund or an investment crowdfunding that's not limited to capital gains rollovers. And the tenants might be your investors in this because it's a shared economy approach where you're saying, yeah, we're all going to share in this equipment. So one of the easiest ways would be to invest into a entity of some kind that's holding the title to the equipment and they each own a part of that. And then if you can rent it out to other people, there may be some extra revenue along that line. Contractors who would build this out, I'm continuing to have conversations, particularly on the large real estate development projects, where we're talking 10, 20, 30, 40 million dollars to build this out. The contractors who are brought in are going to make a substantial profit by being the selected contractor for that particular project. And if they were to invest in this, particularly at the seed round, to get this whole thing planned and designed and engineered, they can make themselves the exclusive vendor of those general contracting services. So they're essentially building a client, building a work base, and getting a double benefit because they're going to charge their standard rates plus get an equity interest in the property. So they're kind of secured in a very good fashion. And if they have enough capital, it's good. And the conversation we had yesterday, we actually had a general contractor identified who has a lot of capital gains and is trying to figure out what to do with them. This would give them an ability, again, to basically forward and amplify what they already are, maybe create a workload to keep them busy for the next 10 years. Suppliers, in the same way that would be like the equipment suppliers. Sometimes when you're doing a build out of this nature using unique or state-of-the-art equipment, some of these suppliers will provide the equipment at a discount or for free in a best situation because they need a showcase for this. They need to tell people this is being used in this place, and this is true particularly in the hemp industry right now, where all the extraction equipment is in a very ugly foot race to try to prove which one is better than another. And we have a number of local companies who are bringing out their own versions of the different extraction equipment, and they might be happy to put the equipment in there as a showcase. And if they didn't want to do it for free, they might take an equity stake or participate in the rentals as an offset. So it'd be, in effect, an in-kind investment rather than a cash investment, which still qualifies you for tenants to bring them onto the site. And then I put on opportunity zone investors because you're in an opportunity zone. We're seeing the definition of who is an investor continuing to move around. We have the very large funds, classical investing, but more sophisticated investors. We're seeing some large money coming through some wealth management programs, which does not appear to be very sophisticated. They're simply trying to avoid capital gains tax and look for reasonably safe investments. We're seeing people are doing this strategically, where they see this as a chance to move their own agenda forward by teaming with somebody else. And then we have people who really don't understand what they're doing. They're not sophisticated investors, and they're looking at the fact that the stock market is bouncing pretty seriously. It may still experience an even further correction than it did through the last quarter of last year, and they'd like to be in a safer place for the foreseeable future. So, and I expect we're going to see more definitions and more varieties of investors coming forward who may be people to look to. So as you're looking at the options, you'll also start shifting who might be potential investor candidates in this. So then deal structures, you could do something where the company owns the property, so you could take a direct equity investment into that company and give up part of the ownership in that particular business. Or you might, if you're going to build a new building or new housing, you might break that out as a standalone project or a subsidiary of your existing business, so that, and then take investment into that particular entity. So you're not giving up control in your original business, but it is a partial ownership, maybe even control, even potentially a majority owner investment in a subsidiary where you're basically piggybacking onto their money as they're building that new property on your property. You want to leverage this when it makes sense. Initially, we were seeing a lot of bank loans at rates that look like they would be a lower cost of money than getting money from an opportunity zone, but we've now talked to a number of opportunity zone funds who have said, that they might be happy with a 6-7% ROI, and that might turn out to be cheaper than some of the bank loans that are available right now. I have a loan right now that's tied to LIBOR, and it's up to 9 points already. So I'm now looking at the possibility of doing a funding of a project. We do the whole project rather than considering leveraging it out. And then there may be some economic development grants because you're creating a unique asset in the community, something that may be considered a amplifier in the community. There are grants available through the Department of Commerce, Economic Development Administration. You may even find that you still qualify, even though you're in an urban area, for funding from the USDA. And then there may be local or regional money that may become available, and the theme that you give by how much equipment and how you point your particular setup of this will dictate who you should talk to in that regard. The capital raise, an opportunity zone investment. The person who has the capital gains has to make a cash investment into an opportunity zone fund. The opportunity zone fund has to make a cash investment into a business or into property. Now, the business may then engage in certain forms of financing, but there are restrictions on those businesses, and this is a gray area right now as to whether you can engage in things, and also it's something that may be difficult to prove that you're doing 50% of your business within a zone. But you're going to start off with private capital if you're going the opportunity zone route. The investment crowdfunding would be basically a distinction between, saying, doing a private offering, taking the money out of an Opportunity Zone fund. That would be considered a 506C or B type of offering for securities purposes, limited only to accredited investors or limited number of non-accredited. If you go investment crowdfunding, then that opens it up to an unlimited number of non-accredited investors, and you can raise up to $2 million under the Crowdfunding Act, or up to $5 million under a limited offering here in Colorado. If you do a national crowdfunding campaign, Reg CF is $1 million, and Reg A Plus is a $50 million limit. Back to bank loans again. That's basically doing a bank loan application, and then grants if it turns out that you can demonstrate that this is somehow advancing any number of economic development programs, or maybe even find a foundation where your work is something that aligns with the mission of a foundation.
So the funds, the sources for this capital, if they don't come from capital gains, they would
come from standard sources.
Correct, but you need a certain ratio, correct?
No. Okay. You will have two buckets of money, and so for technically an Opportunity Zone fund can hold both capital gain rollovers and non-capital gain rollovers, but nobody is recommending that you do that. So there's basically, you'd bring your capital gains in through the Opportunity Zone fund to keep it clean. It's limited just to capital gains, but you can set up other mechanisms to the side, or a direct investment into your business through these other classical forms of funding that are out there. And no, there's no ratio. Because you're bringing this money into a business that's already in existence, there are some, I will say it's an area that's discussed, but you can spend this on enhancing the property, and because you're not buying the property, you're enhancing the property. You don't get into what's called the enhancement rule. So right now, if I were to buy raw land or a building with Opportunity Zone funding, I'm required to spend as much again as I spent to buy it to enhance it. But because of this way this project is structured, I don't see you having to meet that threshold. So it's still possible, though, you would spend so much money on enhancements or a new building that this would solve the match requirement anyway. So that gets us to questions and challenges. Julio had a chance to review the draft of the guide before tonight's meeting, and sent me some questions, and then through the different programs that I've seen or observed over the last few weeks, I threw in a few more questions that came up, and so we'll go through each of these now and kind of talk about what these are. And if you have any questions, please ask them to get your own questions answered. But the first one was broad or narrow focus, and this had to do with how to style this property if you're going to do co-working or co-laboratory or co-manufacturing. Too specialized of equipment is going to very much narrow your field. It may or may not increase the cost of the equipment or the outfitting of the building. And so any decision here is going to have to look at how much it narrows your market, how much it's going to raise your cost. So you had indicated that you might want to do something that maybe is a little more technical than a classical co-working space, but not too much more. Because of your concern that it might narrow your market too much for tenants. And unfortunately, there's no simple answer to that. You're going to have to look at different themes for different industries, and in a perfect world, you would have feedback from potential tenants telling you, yes, I would move in here if you would do this, this, or this. What I learned in talking to a number of different groups is there's a huge number of potential tenants working out of their garages right now, and they're at the limit. Either their wife's going to throw them out. It's not to be a sexist remark. It's just a fact of life. even though everybody knows the garage is the man's only part of the house that he owns. It may be because their equipment's too hard, or they're starting to have some issues where they need a hood or some other equipment and can't work there. So you might find there's a surprisingly large number of people that would like some common mixture of equipment without having to get too specialized, who just need a little more space or a little more formal space, or someplace else other than their garage or outbuilding or barn to work out of. Competition-wise, we talked a little bit about the fact there are other incubators and stuff out there. I think it would be relatively easy for you to niche in and say, you know, I'm not going to be the Innosphere and I'm not going to be a co-working space. I'm going to be more technical rather than less technical, or more mechanical than less that. And depending upon the programs, that might also give you another way, because when you have nothing but desk and chairs, you really don't have much to offer, where any single piece of equipment can make a big difference. Integration with local economic development, I think it would be good to sit down with the EDC for Larimer County and also with the city of Fort Collins and talk to them about your thoughts here and where they could give you feedback and go, here's a problem, or here's a space we need to fill, and get that market feedback, because they may be working on something that is identical to what you want. You don't want to match that or be redundant. At the same time, they may go, I've got this list of garage inventors here that I'm ready to bring to the table if you have this type of equipment in here. The next one are property owner options. And I think this was your question. Do you recall it framed that way or not?
I don't remember exactly.
I think that may had to do with the question was whether or not you could take the investment into the business or into the property.
Oh, that's right.
Yeah.
So there's two ways of making an opportunity zone investment, either directly into the property or in a business that is located in the property. So is it possible to have both?
Well, that's a separate question. So yeah, there's two parts to that. So
okay.
You already own the property.
Mm-hmm.
So one of the restrictions on opportunity zone investment is you can't sell your property, take the capital gains, and reinvest it back to buy the property from yourself.
Yes, that's right.
That if you hit, there is a limit if you're under 20% as you go in. So one of your choices might be, well, I'll go form a new business. I'll sell this, put my money into it, and I'll bring in other investors, but you can't come in at more than 20%. Right. I haven't yet figured out a reason why I would do it that way. It seems to make more sense for you to take investment into your business or create a project on your property, like a brand new office or a brand new housing project, and you can, as I say, create a subsidiary and bring the money into that, and that one you don't have to retain majority ownership or other ways of doing it. So there's a number of ways you could team with other people, including somebody says, well, I'd love to have a building out there for my headquarters. And you go, okay, we'll scrap the shed or we'll straddle the creek with a really interesting walkway, you know, where you can see it flooding in the spring or something like that, and have fun with that. The other thing is, can you have multiple opportunity zone funds being used? And the answer to that is yes, that's possible. We took a greenhouse project apart, and we broke it out to the property, to the building, to the equipment in the building, to projects that are operated within the building. And if we put a solar farm with it, we could create that as a side business over there. And so you could end up with 4, 5, 6 different things. Now, those funds might be your fund that you intentionally created for that one thing. So you might bring one in to enhance your existing buildings, create one to build that new office space, one to put in the housing. And right there, you've got 3 different funds, but they're tightly focused. So when an investor is looking at this, they're going, I don't do office, but I do housing, or vice versa. And then, again, you might be able to layer how the money comes in for a particular thing, and you might even buy a suite of equipment, you know, that is funded in a particular fashion to serve an industry association or something like that. Yeah, Lucas?
So let's say you had an opportunity fund for this project that has multiple different layers in it. Would the fund itself be basically purchasing equity in the project, or would it be a loan to the project? Or, I mean, how would that work?
So an Opportunity Zone Fund has to make an equity investment. I mean, they have to buy the property or they have to buy equity in the business. They're not allowed to lend out of the Opportunity Zone Fund. So it is possible you have a single fund that goes through a series of capital raises that are staged over time. But what you might do then is the underlying business. You would create like an LLC or a corporation, which is a business. It holds a series of funds. By pocket funds is another way of looking at it. And so it might be managing all these funds, but the funds would have to be singular because this tranche of money coming in at this time has got to be kept separate from somebody coming in at a later point in time, both for accounting purposes and for the tax purposes. But you could have a single entity that's, in essence, managing multiple funds going in different directions.
When you talk about equity,
Yeah.
can it just be a preferred? And then
It
therefore not
Non-voting
not
or
participating in the upside?
As my understanding, it can be any form of equity.
Okay.
It doesn't have to be like a common stock. It could be a preferred that has higher rights. It could be a non-voting with lesser rights. It just simply can't be a loan. It's got to have something that can appreciate in value so it could someday potentially experience its own capital gain. So that leaves a lot of flexibility in there. It's part of the reason I like opportunity zones, because there's a lot of flexibility here, as opposed to a lot of the programs are either limited to tax credits, or you have to be so many years profitable, or R&D tax credits where you have to pay everybody employment salaries. You can't, a sole proprietor freelancer like me can never qualify for R&D tax credits because we're never paying ourselves a salary to set a baseline. So this one's got all this flexibility, which is why I'm curious to see where it goes. And in combining it with other programs, then I think we can get in some interesting hybrids that might overcome some of the limitations of the other types of programs. But yeah, as long as it's something that can appreciate in value, so like you buy the land, that it's not truly equity, but you've bought the land can appreciate in value as an asset. So there might be ways that you could do things, but they've pretty much said it's property or business. And if it's business, then the land can be held directly by the fund, but if it's a business, it's got to be some kind of equity. It can't be a loan. And there's a bunch of ways of doing that. You can do rev share, which would still qualify as equity, where a loan would not. So then the last one is, can investments be staggered over time? And yes. So you might start off with, let's do a small fund, let's test the waters, let's figure out what we're doing, put in some special equipment, make this a themed workspace, co-space, and then you get comfortable enough with that, or you get enough tenants that you've got cash flowing, and then you can turn around and go, let's do a second fund, even through, again, a different fund under the same banner that is to build the new building, the new office building or work building, and do a third round to do the housing. Now that you have people working in the building who want to walk across the street to work, you can pre-sell them tenancies in the housing project. And then you might do a fourth thing where you put a solar panels all over everything and you create your own solar farm that supports the buildings. And that one is sold as a utility, one's as housing, one's as office space, and one's as a technical mechanical place. So you've got 4 different looks, so to speak, all on the same property. Might have completely different investors because they're different.
And each one of these sources of funding would be subject to its own clock for tax.
Yes, yeah. So again, we talked about this a little bit before the program, but you've got a number of time frames that you have to work with. So once the person recognizes the gain, then they have 6 months in which to put the money into a fund. Once the fund receives money, it has 6 months or December 31st, whichever occurs first, in order to deploy 90% of that money into a project. Once a business receives the money, it's supposed to use it within a short period of time, but if it has a plan which shows why it's a staged application of the funds, and that is in a use of proceeds statement up front, they can get up to 30 months in order to put the money out there. So if you were to raise money for round 3 and it's going into housing, you've got 30 months from when the money's received to get everything in place, which in Colorado should allow you to get your permits and other things done. If you're fighting a zoning variance, that might be something you want to get out of the way before you would consider taking the money on board. Then once the money's into this property, you may be generating ordinary income in the form of rents. Those rents would go to the owners, depending upon how you structure your fund. So if it's set up as a C Corp, the corporation will pay taxes on the ordinary income earned in the form of rents, but the investors into that are watching this appreciate in value over time, and then after 10 years, it can be sold, and any gain from buying out the investors from the fund would be tax-free. You can now go till 2046 as your last day where you have to cash out and recognize your gains. So you've got a lot of flexibility there. What a lot of people are looking at right now is that the optimal use of Opportunity Zone funds will cross the line on December 31st of this year, because that's the last date that you can put money into an investment and get the full 7 years of money at work in order to get the full 15% discount on the capital gains tax. Now, in the scheme of things, 5% reduction of your capital gains tax may be nothing compared to the upside potential of having all the gain in this investment waived after 10 years. So it may not be a big deal, but after December 31st, 2019, you can still leave it in for 5 years and get 10% of your tax knocked off, plus get the deferral and get the back end. And then even after that, as you approach 2026, you still have your 10-year window. Even if you don't get the deduction in your capital gains, you get the deferral of the gain of paying the tax up until 2026. And even if you did it on 2026, you're going, okay, I'm still going to pay my capital gains tax today. I'm going to take the net of my capital gains and invest it in here because I have the upside potential on the back side. So those are the clocks that are ticking, and it's a matter of making sure you're in the zone and on time. Yes?
I have a S corporation that I set up, and I missed the opportunity zone by 2 blocks or 3 blocks.
Sorry?
I do not live in the opportunity zone, but I missed it by about two
Okay.
2 blocks. And the usual way I did was writing a check to IRS from the service that I get, okay, from the contract work. So now this year, if I want to invest on the opportunity zone, do I have to write a check to the opportunity zone, or I have to, how would I report to the IRS and all those kind of things?
Yeah, so the way it works is if you have a capital gain from an investment you've sold, you have to invest that into an opportunity.
From the service.
Pardon?
From the service, contract work.
Well, contract work won't create a capital gain.
Okay.
That's ordinary income. So it will not qualify for investment into an Opportunity Zone fund. You would have to sell an asset, typically land or stocks of some kind that's at a higher value than what you paid for it. Ordinary income won't get you there. So any of the consulting work I do is all ordinary income. The rents on tenancy in these buildings would be ordinary income. It would not qualify. Yes, Lucas?
So I understand the idea of keeping it tidy by only having capital gains in the opportunity fund. But really, isn't that burden on the investor as to whether or not, I mean, if I give
Yeah,
$100,000,
yeah.
say this is a capital gain.
Well, yeah, let me get to your question in a moment. Let me finish. So the question that's on the table is, one, what kind of money can I invest in an Opportunity Zone fund?
Right.
And it has to be a capital gain. And there's some easy examples of that, and then there's some less easy examples. But general sales services won't get you there. you typically are looking at sale of stock or land as a source of your capital gain. There's some other things that may qualify, but you're going to get outside my tax knowledge in order to do that. If you have a capital gain, then you have to invest that cash into an Opportunity Zone fund. That fund can be created by you for your own business, for your own project, or it could be another fund that has been set up that is looking for investors like you to pool their money together to do something. So you may see a community set up something like that. The gentleman that was here earlier was working for a large financial institution. You'll see banks doing this, where if you're one of the wealth managed clients, they'll have an opportunity for you to move your money out of Wall Street, your capital gains, and put it into an Opportunity Zone fund. But ordinary income won't get you where you want to go.
But the 401k and others will qualify for that.
If you have a 401k or an IRA, there's really not probably any reason for you to put your money into an Opportunity Zone fund unless the tax advantage of doing that is somehow greater than what you're getting within the scope of your pension. It's possible to have a directed IRA or 401k, and it's possible you have capital gains that have been realized within your retirement fund, but you would have to borrow that money from the fund and then invest it across in order to do that. And since it's not clear that you're going to get a better tax treatment, it may not work. We had a similar issue where people had money in property and they sold it, and they have the ability to roll it into another property of like kind called a 1031 exchange. And their ultimate intent was to roll it into their estate upon their death. So it didn't seem there was any advantage of going into an Opportunity Zone fund, because the way the tax laws were constructed, they would get it as good or better a benefit just by leaving it in the property as they go forward. But every situation ends up being kind of unique and different, so you have to ask the question, and look at it to make sure that maybe this is workable for you, but you're going to have to do some calculations to see. And right now, I don't see pulling money out of a pension fund and making an investment. There may be situations where that would work, but I don't see it. Lucas, your question again?
So the question is that when it comes to sourcing funds, if you've got 10 different investors and you say, I'm in for 1,000, whatever, as the fund manager, how do you know you're accepting capital gains into your opportunity fund?
Well, if I'm a fund manager, I would be making them warrant to me that that's capital gains money, so I'm not potentially cross-contaminating all the other investors that are there. So they'd have to make an affirmative representation, which if it proved to be false, would give me grounds to take action against them for any penalty that might be incurred. On one hand, they will then in turn, the person who made the investment, when they file their taxes, there's supposed to be a place, and I haven't had time to look yet, in this year where you say, did you have a capital gain this year? There should be a box that says, did you roll it over into an Opportunity Zone fund? If you check the box, that is supposed to pull that off and defer that. And then the IRS, and I'm anticipating this because we're just thinking through how this would work, the Opportunity Zone Fund has to file originally with the IRS to get its status. That's a notice filing. It's no overview, no due diligence. But then if they create a fund, they would report that to the IRS. They'd report the amount of money that's in the fund. They're required to report twice a year. And in that, they go, yes, we received this much money and we deployed this much money. And the IRS, can cross-check to see, well, what are the tax ID numbers of the investors versus what's filed on their tax returns. And if there's an error in there, it should show up. It shouldn't be a penalty in a formal sense, but if you, and technically even from another sense, if you invest that over, there's really no downside. You just don't get the tax benefits at the end of the day. Because it wasn't it wasn't a capital gains rollover, so it's one of those things where it might not make any difference to the fund or to the other investors. But when the IRS catches up, they'll go, that's not a capital gains rollover. So you don't get the tax benefits. Yes, Tom?
Karl, is an opportunity zone fund a legal entity of some sort?
Yeah, you'll set it up either as a corporation or as an LLC or even a partnership. It has to be a new entity, and it may either be a pass-through, meaning its sole purpose is to raise the money, receive the funds, and deploy the funds, or it can be an operating entity, particularly with real estate, where its sole purpose is to do a particular project, and they're going to manage the entire project from within the framework of the fund.
So if you form an LLC with the sole intention of investing in an opportunity zone, money that goes into that fund doesn't necessarily need to only be capital gains, right? It could be any money that someone wants to just invest into an opportunity zone.
Well, let's hold up a moment, because you created a factual scenario that won't work.
Okay.
So you're talking about potentially multiple types of investors putting money into an LLC, and then the LLC investing into an opportunity zone fund?
Well, no, into a property in an opportunity zone.
Okay. So the question on the floor is in structuring the investment into a fund, and then the potential of the fund to participate with other types of money from other sources into a single property. Is that correct?
Yeah.
Okay. Yeah, so that would be workable. That would be similar to saying we're going to create a syndicate of investors who are going to put money into this particular project, like some of the ones I'm working on now. And some of the money is going to come from an opportunity zone fund, and some of it's not. The big deal there is that depending upon the natural maturation of this project, if I'm doing an ordinary property development, I might be at a point of cashing out in 1 to 2 to 3 years. And this type of investor may want to come out, and the opportunity zone people want to stay in for the full 10 years. There's ways to do that, but you're going to have to anticipate all that within structuring this. So you may have somebody who says, well, I'm gonna create tiers of ownership in this project. This is the long-term money, the patient capital. This is the short-term money. Different rates may apply for the price of money based upon doing that. And that has happened in other types of real estate projects. It's just in this one they get an extra bonus in terms of holding for 10 years. They get the greater benefit on the tax return. Other questions? Yes?
You talk about having a business sitting on a property, for example,
Right.
in that example. You need some pretty flexible bankers if you're going to take debt on to do that. I'm just asking about experience in that regard.
Yeah, so the question is if you already have a developed property and you're looking at taking in more equity, but also leveraging that equity investment from Opportunity Zone with a bank loan, the bank was going to look at this like any other form of investment. They don't care that the equity is in there for 10 years or it's from Opportunity Zone money or anything else. They're just looking at the debt to equity ratio and looking to the value of the property as collateral behind the loan. And I mean, from their standpoint, whether I put the money out of my own pocket or I created a crowdfunding campaign and raised the front end money, or I got it from Opportunity Zone Fund, the bank still has its own criteria. They're not going to change those. And if the bank says that, I want an 80-20 ratio, and I've got the 20% down payment, so to speak, on the property, then I've met their criteria. If I'm going to do something odd with the project, like I start growing marijuana on it right now, then I'm going to be flagged, and I'm not going to get money from almost any bank I know of right now. The banks are still getting up to speed on what they can and cannot do with hemp, and it may take us till fall before some of those figure out whether they're going to do anything at all. But it's the same issues. I mean, the fact it's Opportunity Zone money in some ways may be viewed as even a better quality equity investment because it's going to sit there for 10 years.
Right.
So the bank's not worried about you flipping it or doing something else that might somehow put the property at risk along that line. So it'd be interesting on an individual bank-by-bank basis to talk to the lender or have some feedback from the loan committee on whether this is new, different, or we don't care.
Okay.
Yes, Tom?
One more question.
Sure.
I have a friend who started a townhome development over by Sloan's Lake. and it turns out that it's in an opportunity zone, but they've started this project well before anybody knew what opportunity zones were.
Right.
So can they still benefit from the opportunity zone for this project?
So yeah, so the question is if you have a project that's already in motion, can you potentially benefit from opportunity zone money? And the general answer is maybe. Because Julio is sitting here talking about upgrading property within the framework of an existing business. So there are ways where the money's coming into a business for the purpose of the business, and it all works. There's other situations where if they're coming into this, you have to say, is the property done? I mean, is it fully baked, or they're still in development? And if it's still in development and there's intended to be a third tranche of money or a final tranche of money or division 3, source of money, carve that out as a project, and you could either make a direct investment potentially into the property or into the business that's developing the property, because the money will serve the purpose. It's being spent within the zone to create tangible enhancements to the property. And that nature of development is obviously going to meet any matching requirements that's there, where the property's one value, you have to put in at least 100% enhancement to the property to meet the requirement. So it shouldn't have a problem with that. Now, as they've designed it, it may not have been, I'll say, fractionated out in that fashion. They may need to go back and retool that in some way if they want to pursue that specific investment model and go after that type of money, where they may have had it all in one form. They may say, okay, we're going to stop here. We're going to carve out this piece and pull it out of this area, which may or may not work with the existing investors or banks, and make it a brand new project.
All right. So if I'm not sure where they are with their finances, but assuming they have all the money lined up already, and this project is already broken ground, in 5 years from now, they're going to be sitting on a significant capital gains.
Yes, but there are projects who had bad timing. This one project I'm working on, the Sugar Beet District project, if they had raised the money last year or the year before last, it would have been bad timing. The fact that they couldn't get the money raised somehow is working to their advantage. Who knew that this was going to turn out that way? So there's all kinds of different potentialities there, where just wrong time, wrong place, wrong location, other things may come into play. They may not be able to take advantage of this, but they might even look at buying out the original investors or refinance or doing something along that line that would make sense. But you'd have to look again at the unique situation that they're in, where they're at in development, and see what their options are.
So they'd almost need to set up another LLC that's an opportunity zone fund and buy the project from themselves. Would that work or no?
Well, the rule is that you cannot sell your property into an opportunity zone fund that you previously sold. So you can't sell it back to yourself. Okay. That doesn't mean they couldn't sell it to a total different group of investors, in effect cashing out in a way, and might even take a carried interest in a way that allows them to partially cash out now and lay off the balance on someone that still meets the rule requirement.
Sounds complicated.
Well, unfortunately, the fact you have to create an entity most of the time is a dedicated fund to make this work, and you then have to meet these timelines. It does create some levels of complication. And back to my earlier comment, I think the sweet spot on this are projects that were at the margin, that were just barely unfundable before, and the Opportunity Zone puts them over the top. And we're seeing lots of small businesses that were in that area, seeing a lot of community projects where they want to do something that is I will call it a economically sustainable model that wasn't generally attractive as a regular investment. With Opportunity Zones, it might be. Beyond that, it's just another way of making more money. So there's, at least I know one group that is just getting ready to punch a bunch of oil wells, and they're in an opportunity zone. So, yeah. And the good or bad news was they raised the money, but I don't know if it was opportunity zone funding or not. I'm trying to find out right now. But there's, it's there, and you're also, a lot of people are unhappy, and there were some people that spoke up at the deal-making conference. What are you doing about gentrification? Because you come into a low-income community and you buy up everything from out-of-town landlords and scrape it, and you just displaced everybody in that community and everything that goes along with it. So there is the potential for what some people would consider to be not positive, for the community, even though it may be highly profitable, and vice versa. Yes. So what I'm going to do is I'm going to wrap up for tonight. And one last question, Bob.
When you say if you're an investor with your capital gains money, and in this process you die, do you get a step on the basis of that, like you used to do with your estate tax situation?
Bob, that's a great question. I'm going to say I don't know. Okay. Because I'm not sure how that asset passes into your estate, so I don't know if it steps up or how that's carried. That's an issue I'm going to write into my issues list, and we'll see if we can track down somebody who can answer that. And if so, if we don't get it into the guidebook for tonight, we'll post it up on the discussion page in the meetup.
Cool.
So thank you very much. I appreciate the questions.
Yeah, thank you.